All right, so it looks like we're looking at a mixed picture in retail, a mixed picture when it comes to meme stocks and a cooling housing markets. What does all this mean for you? We want to take a look at the broader moves that we're seeing in the market. For that, we want to bring in Lenore Hawkins, Calit Advisors partner. Lenore, it's great to see you. How are you looking at the recent stall that we've seen in the rally, the Dow lower, coming off its worst day that we've seen since June, and some of the mixed data that we're getting on the earnings front, but also on the econ front when it comes to housing?
Yes, it's been really interesting. The big argument has been, have we seen the bottom? Has this been the market bottom, and then are we moving our way up, or has this been just one of those bear market bounces? So no one really has a crystal ball. So let's look at what normally happens throughout history. Right now, we have the Fed tightening into an inverted yield curve, and the economy, for the most part, most indications that the economy is weakening, and earnings have been weakening. Overall, some are doing a little bit better, but in general, it's been more downgrades, more dire outlooks. The guidance has been weakening, not strengthening. And historically, market bottoms occur after the Fed has been easing actually for quite some time. And normally they actually occur after the last rate cut, not hikes, but rate cuts. A market bottom tends to happen when the yield curve is positively sloped and actually steepening, and when the economy is clearly improving, not weakening. And historically, and this is also really important, if you look at the stock market, when we see a market bottom, value stocks tend to do better than growth stocks. Cyclicals take over from defensive. So we've seen this in 2009, 2002, keep going back. That's pretty much always what happens. This time, growth outpaced value by over 800 basis points. That's not what you see at a market bottom. And we've seen a nearly 3-point multiple expansion in PEs. And that's while guidance is lowering and analysts are downgrading. That's not what you see at a market bottom.
So a lot of confusing signs in here, but perhaps the market, perhaps all of us were a bit deceived, because in your notes you point out that much of the gains from that mid-June lows were in just 4 stocks. How much did they comprise that rally, at least in the S&P?
Yeah, it's pretty amazing. You look at since June, it's been Apple, Microsoft, Amazon, and Tesla. Together, they make about 18% of the S&P 500, but they've generated about 30% of the gains over that time. So that's really outsized performance. And you got to not forget Bob Farrell's market rule number 7. Markets are strongest when they are broadest, and they are weakest when they are narrow. And when you see just 4 stocks accounting for most of the gains, that's not a strong market.
And Lenore, I want to talk about the strengthening dollar and the impact that that's having, because as we saw what happened with the euro now going below parity. What are you watching in terms of the strength of the dollar and the impact that's going to have?
Yes. Well, so what we saw when the market started kind of doing this correction, looking like it was improving, people were thinking, oh, the Fed, they're really front loading these rate hikes, and then we're going to start seeing cuts pretty soon in 2023. But then we started hearing Powell sounding more hawkish. You have 4 Fed officials that are saying, yeah, 75 basis points at the September meeting. So that's just meaning, oh, wow, rates are going to be higher for longer than we expected. And that is powerful for the dollar. That makes the dollar stronger to other currencies. And we're seeing the dollar break through major overhead resistance levels. Now, that's great if you're a tourist deciding to go to Europe for the summer. Not so great for American companies that sell abroad, right? That makes their products much more expensive. So it's a real headwind to American companies that have a good portion of their revenue coming from overseas. That's definitely a lot of those tech stocks.
Yeah, we certainly have heard a number of executives over the last several weeks during this most recent earnings cycle cite the strong U.S. dollar as a headwind here for their company over the coming months. Lenore, what about the bond market? I was looking at yields. The 10-year yield seems to be in this uptrend, holding above 3% once again today. Is this a trend that you think is going to stick?
I think it's going to stick for a bit, but as they say, high prices solve high prices, and high yields are going to solve the problem of inflation. We're already seeing inflation signs starting to roll over. When you look at new orders versus inventories, that ratio really indicates there's a lot of inventories. Companies aren't placing a lot of orders. You're going to have to work through a lot of that inventory. Those are downward pressures, and all of that means a change in rates. And when you look at that implies growth and rates go together. And as those expectations for growth start to come down, so will you see the rates come down. But all of this is going to be dependent as well on what the Fed is doing.
And Lenore, what does all this mean in terms of what we've seen with forward guidance, expectations for investor sentiment?
Oh, sentiment. Now that's been tough. We've really not seen something quite like this. The AAII survey sentiment hit the most bearish level in history. The U.S. Investor Intelligence Survey puts investor sentiment right about where it was at the Great Financial Crisis. And even more interesting to me, the Bank of America Global Investment Strategy Bull and Bear Indicator, that's a long one, it's been at 0. So what that means is that the big guys, the pros, they have been so downcast on this market, more downcast than we normally ever see. Now, what that does kind of give you a bit of an indication that downward risk in the market is not super high, because if everybody's really excited about the market and thinks things are great, then your risk on the downside is much higher than if everybody's like, oh, this is just the worst market ever. So that's kind of a positive indicator. But like I said, with the economy still and across the world, things are not looking good going into the winter months. Europe, where are they going to get energy? I mean, it's really dour. But some good things for investors to look at is the pandemic really did a number on the workforce, right? We saw labor participation rates plummet. And since then, it's improved, but not massively. You'll have a lot of retirees going into retirement early. We also have really low, relative to historical norms, immigration and a super low fertility rate, which means the population's growing really slow. And an economy grows based off just two things: growth of the labor pool and growth of productivity. Put all that together, what that means is companies are going to be investing in the things that make people more productive. You can't grow the labor force, but you can improve that productivity. So that's a huge tailwind for automation and all those things that make each worker more productive. So that's good news in a market that's a little difficult.